So in this video, we will solve few questions on accounting for bonds payable. So already in one of the previous chapters, that is investment in debt securities, we discussed that investment in debt securities can be classified into three types. One is trading debt security. The second one is available for sale debt security. Then held to maturity debt security. So we already discussed in the chapter that trading securities are valued at or measured at fair value, and any unrealized gains or losses are taken to P&L account. Available for sale securities are also measured at fair value, but any unrealized gains or losses are taken to other comprehensive income. So this is the difference between trading security and available for sale security that we discussed. Held to maturity security are measured at amortized cost. So since we have already discussed trading debt securities and available for sale debt securities in the previous chapter, in this chapter we are going to focus on held to maturity debt securities. We are going to discuss what is amortized cost and how to calculate it. So look at the first fact pattern. So based on this fact pattern only, we are going to solve the first four questions. So the first four questions are based on this fact pattern given above. On January 1, Evangel Company issued 9% bonds in the face amount of $1 lakh, which mature in 5 years. The bonds were issued for $96,207 to yield 10%, resulting in a bond discount of $3,793. So before proceeding further, let's understand the numbers that are given in the question. First, the bonds were issued on January 1. So that is nothing but the issue date. Here, what is this 9% and what is this 10%? So they have given two percentages. One is 9% and the other one is 10%. This 9% is nothing but coupon rate of the bond. The company is going to pay 9% interest to the bondholders for the next 5 years. So today the company is going to receive the money. At the end of the first year, they will pay 9% interest. At the end of the second year, they will pay 9% interest. Third year, 9% interest. Fourth year, 9% interest. And at the end of the fifth year also, they are going to pay 9% interest. Now, one more important thing that we need to understand is this coupon is going to be fixed. It is not going to change. Next, we have this 10%. What is this 10%? This 10% is known as the yield. Now, how to interpret this 10%? To put it very simple, at what price the bonds are issued today? Today, the bonds are issued at $96,207. So, as an investor, he has to purchase the bond for $96,207. If he is purchasing the bond today as an investor, if someone is purchasing the bond today at $96,207 with an intention to hold it till its maturity. What is the maturity? 5 years. So with an intention to hold it for the next 5 years, he can generate 10% return. I hope you are all understanding it. So this 10% yield is nothing but if someone is purchasing the bond today at the issue price with an intention to hold it till the maturity, he can generate 10% return. But you will have a question. The company is paying only 9% coupon, but still, how the investor can generate 10% return? It is nothing but this 10% includes interest at 9%. The company is going to pay 9% interest at the end of every year, which is nothing but coupon. So this is fixed. Now the bonds are issued at a discount. The bonds are issued at $96,207. So today the investor has to pay $96,207. Today he has to pay $96,207. But after 5 years, he is going to get back the face value of the bond. At the time of redemption or at the time of maturity, the investor will get back 1 lakh. So to put it very simple, today I am investing 96,207. After 5 years, I am going to get back $1 lakh. So there is a capital gain. Capital gain of how many rupees? 3793. So this 10 percentage includes interest at 9%, the coupon of 9% plus some capital gain. So here, even though the company is paying only 9% interest, the investor can generate more than 9% because of the capital gain. That capital gain is nothing but the difference between how much he is investing today, 96,207. After 5 years, how much he is going to get back? $1 lakh. So there is a capital gain for the investor. So he can generate more than 9%. Basically, he is going to generate more than what the company is paying. So the company pays 9%, but that 9% is not the only cost for the company, because the company is receiving only $96,207 today, but after 5 years, they are going to pay $1 lakh. So it is a capital loss for the company. So capital loss for the company is $3793. Why? Because they are receiving 96,207 and after 5 years, they are going to repay 1 lakh. But for the investor, it is a capital gain because he is investing only 96,207 and after 5 years, he is going to get $1 lakh. So it is a capital gain for the investor and capital loss for the company. Evangel uses the effective interest method of amortizing bond discount. What is effective interest method and how to calculate the numbers, that we will discuss. Interest is payable annually on 31st December. So here, who is going to pay the interest? The company is going to pay the interest. At what rate? 9%. 9% of what? $1 lakh. So please remember, this coupon rate should always be applied on the face value of the bond. This $1 lakh is the face value of the bond. On this 1 lakh, the company is going to pay 9% interest. So the company has to pay $9,000 interest. When they have to pay? At the end of each year. That is on every 31st December for the next 5 years, the company is going to pay $9,000 interest. Now for any question based on accounting for bonds payable, we can follow a particular format. That is, so see, there are different requirements of the question. What is the amount of interest expense? What is the amount of unamortized bond discount? All these things we are going to solve. But we will solve the full question. Then from the full solution, we can get the answer for these questions 1, 2, 3, and 4. It's based on this fact pattern. So based on this fact pattern, we will solve the question for all the 5 years. And then we will do the question number 1, 2, 3, 4. So for all the questions based on accounting for bonds payable, we can follow a particular format, that is year, opening balance, then interest payable, interest expense, closing balance, then amortization of discount. Here we have discount, so we are amortizing the discount. Suppose if we have premium, then we have to write it as amortization of premium. So year 1, 2, 3, 4, and 5. So it is a 5-year bond. So what is the opening balance of year 1? Opening balance of year 1 is nothing but the price at which the bonds were issued. In this case, the bonds were issued for $96,207. Basically, they are issued at a discount. Why? Because face value of the bond is 1 lakh. But still the company is issuing the bond at $96,207. So it is issued at a discount of $3793. So this is the opening balance. Now, what is the interest payable? Please always remember, this interest payable is nothing but the coupon rate into face value. And this figure is always going to be a constant. It is not going to change. Interest payable is not going to change. So what is going to be the interest payable? The face value of the bond is 1 lakh. Coupon rate is 9%. So when we apply 9% on 1 lakh, we get $9,000. So that is the interest payable. Now, how to calculate this interest expense? This interest expense is nothing but yield into opening balance. What is the yield? Yield is 10%. What is the opening balance at the beginning of the first year? 96,207. So 10% of 96,207, we get 9620.7. We can round it to 9621. Now, how to calculate this closing balance? Listen, at the beginning of the period, the company had opening balance of 96,207. They should have paid $9,621 of interest. That is the interest expense. They should have paid $9,621 of interest. But they are actually paying only $9,000 of interest. So this closing balance is nothing but opening balance minus interest payable plus interest expense. Logic is very simple. At the beginning of the period, we had $96,207 as the opening balance. During this period, they should have paid $9,621 as interest. So that will increase the value of the liability. So we are adding it. Even though we should have paid $9,621 as interest, we have paid $9,000 actually. So that will decrease the value of the liability. So interest expense is added because that is what you have to pay actually. And interest payable is subtracted because that is something you have actually paid out. So this is actually paid out. This is what actually you have to pay. So the closing balance will be 96,207 plus 9621 minus 9,000. We get $96,828. This is the closing balance. Now, how to calculate this amortization of discount? This amortization of discount can be calculated using two methods. One is, it is nothing but the difference between the opening balance and the closing balance. What is the difference between opening balance and closing balance, or closing balance and opening balance? Closing balance is 96,828. What is opening balance? 96,207. So minus 96,828 minus 96,207. We get 621. This is one way of calculating amortization of discount. Or it can be alternatively calculated as the interest expense minus interest payable. That's all. Both the calculations will give you the same number, amortization of discount. Now, what is the 621? How to interpret it? Listen, the company issued the bonds at a discount of 3793. Now, what they are supposed to do is this $3793 of discount has to be amortized over the period of 5 years. So in the first year, they have amortized $621 of discount. So still there is an unamortized discount of how many rupees? They issued the bond at $3793 discount minus at the end of the first year, 621 is amortized. So still they have to amortize another $3172, which has to be amortized over the next 4-year period. So now this closing balance of the first year will become the opening balance of the second year. So 96,828 is the opening balance of the second year. Again, as I already told you, this interest payable is going to remain constant. Why it is constant? Logic is very simple. Coupon rate is always constant. Face value is always constant. So product of these two, that is interest payable, is also constant. So interest payable is 9,000, which has to be subtracted. Plus, we have to calculate interest expense. How to calculate interest expense? It is yield into opening balance. What is the opening balance? 96,826. What is yield? 10%. So what will be the interest expense? 10% of 96,826. We get 9682.6, but we can write it as 9683. We are rounding it to the nearest digit. Now, what will be the closing balance at the end of the second year? 96,826 minus 9,000 plus 9683. We get $97,509. Now, what will be the amortization of discount? The amortization of discount is nothing but either the difference between closing balance and opening balance, or the difference between interest expense and interest payable. So we get 683 as the amortization of discount. So similarly, we have to carry this process for the subsequent years as well. Closing balance of second year will become the opening balance of third year, 97,509 minus interest payable is 9,000. What is the interest expense? 97,509 is the opening balance. For that, we have to take 10%. We get 9750.9. We can round it to 9751. So what will be the closing balance? It is 97,509 plus 9751 minus 9,000. We get the closing balance as $98,260. So the amortization of discount is 751. Closing balance of third year became the opening balance of fourth year, 98,260. Interest payable remains constant at 9,000. Plus interest expenses 10% of opening balance. So here it is 9826. So the closing balance will be 98,260 minus 9,000 plus 9826. We get $99,086. So the amortization of discount here it is 826. Fifth year, the opening balance of fifth year will be closing balance of fourth year. It is $99,086 minus 9,000 plus what is interest expense? It is 10% of opening balance. So here it is 99,008.6 we get. So we can round it to 9909. So what will be the closing balance at the end of the fifth year? It is nothing but 99,086 minus 9,000 plus 9,909. We get $99,995, which is almost equal to $1 lakh. There is a difference of $5, which is due to the rounding of error. That $5 difference is due to rounding of error. So here the amortization of discount is nothing but 909. Now amortization of discount column is there now from here till here. If we add everything, let's see how much do we get. That is 621 plus 683 plus 751 plus 826 plus 909. So 621 plus 683 plus 751 plus 826 plus 909. We get 3790. So actually we should get 3793. But due to the rounding of difference, we are getting $3790. So here the summation of all the amortization of discount is 3790. Actually, it should be $3793. So that $3 difference and $5 difference is due to the rounding of error. So what I'm trying to say is at the end of the or at the time of maturity, the closing balance of the bond should be equal to the face value, whether it is issued at discount or whether it is issued at premium. Doesn't matter. It should be equal to the face value. If it is issued at discount, let's say face value is here 1 lakh. If it is issued at discount, then the value of the bond will increase over time. So this over this 5 years period, you can see the value of the bond is increasing. Every year, the value of the bond is increasing. And at the end of the fifth year, it will reach this 1 lakh. Let's say the bonds are issued at a premium. Let's say something greater than 1 lakh. Then what will happen? Every year, the value of the bond will decrease. And then at the end of the day or at the time of maturity, will reach this face value 1 lakh. Now here we have to understand few things. That is, if the bonds are issued at discount, I think I can write it over here. If the bonds are issued at discount, the interest expense will always be greater than interest payable. If bonds are issued at discount, interest expense will always be greater than interest payable. Why? Because interest payable is what? It is calculated as 10% of opening balance. Interest payable is calculated as 9% of face value. So this is 10% of something and this is 9% of something. So interest expense will always be greater than interest payable if the bonds are issued at discount. And that is the reason why value of the bond is increasing every year. You can see at the opening of the first year or at the beginning of the first year, value of a bond is only 96,207. But at the end of the first year, value of the bond increased to 96,828. So the value of the bond increased by 621 rupees. Suppose let's say the bonds are issued at a premium. In those cases, interest expense will always be lesser than interest payable. Why? Because before that, we need to understand one thing. Here, why the bonds are issued at premium? Sorry, why the bonds are issued at discount here? First, because the investors are expecting 10% return, but the company is paying only 9%. So to attract the investors, the company is issuing the bond at a discount. That is, if yield is greater than coupon, the bonds are issued at discount. If yield is less than coupon, then the bonds can be issued at a premium. So in case, when you can issue the bonds at premium, the bonds can be issued at premium only when when the coupon is greater than the yield. So if bonds are issued at premium, what is happening is interest expense is calculated as the percentage of yield into opening balance. Interest payable is calculated as coupon into face value. So in case of premium issue, coupon is actually greater than yield. So interest payable will always be greater than interest expense because interest payable is calculated as a percentage of coupon, which is more than yield. So if bonds are issued at premium, interest payable will be greater than interest expense, and that will eventually decrease the value of the bond every year. So if bonds are issued at discount, value of the bond will increase every year. If bonds are issued at premium, then the value of the bond will decrease every year. And at the time of maturity, value of the bond will reach this $1 lakh, which is nothing but the face value of the bond. I hope it is clear. Now let's look at the question. First question, what is the amount of interest expense that should be reported on Avengel's income statement for the second year? See, they are asking us to calculate the interest expense, not interest payable. We know that interest expense is calculated as what? Yield into opening balance. So we already calculated what is the opening balance at the beginning of the second year. It is 96826. What is the yield percentage given in the question? 10%. So what is interest expense? 10% of opening balance. The 10% of this 96,826 is 9683. We are rounding it to the nearest number. So interest expense for the second year is 9683. Option D is the right answer. What is the amount of Avengel's unamortized discount at the end of the first year? So listen, at the end of the first year, what is the amortized discount? 621. So the total discount is 3793. The company issued the bonds at a discount of $3793. Out of this, 621 is amortized at the end of the first year. So what is the remaining discount that is unamortized? 3793 minus 621. We get 3172. So option C is the right answer. So this unamortized discount is nothing but at the end of the first year, total discount is 3793. At the end of the first year, we discounted 621. So at the end of the first year, we have an unamortized discount of $3172. Third question, the net carrying amount of Avengel's bonds payable at the end of the first year is how much? Basically, they're asking us to calculate the closing balance at the end of the first year. Closing balance at the end of the first year is 96,828. So option C is the right answer. Fourth question, what is the amount of interest expense? Again, interest expense is nothing but yield into opening balance. That should be reported on Avengel's income statement at the end of the first year. Quite simple. So interest expense at the end of the first year, we calculated 9621. How? It is nothing but 10% of the opening balance. So 9621, option C is the right answer. So this closing balance we have calculated. No, this is nothing but the amortized cost of the bond. Amortized cost is nothing but opening balance minus interest payable plus interest expense. That is the amortized cost. So held to maturity debt securities are valued at these amortized costs. Fifth question. On November 1, Mason Corporation issued 8 lakh of its 10-year 8% term bonds dated October 1. The bonds were sold to yield 10%. Again, what is this 10%? What is this 8%? This 8% is what the company is actually going to pay. It is the coupon. But if someone is purchasing the bond today with an intention to hold it till the maturity, he can generate 10% return. So here, why yield is greater than coupon? Why yield is greater than coupon? Because the bonds are issued at a discount. So if bonds are issued at discount, the investor is not only going to get the coupon, but he is also going to get some capital gains. So the yield is greater than coupon. So here we can see with total proceeds of 7 lakh plus accrued interest. So even though the face value of the bond is 8 lakh, the bonds are issued at $7 lakh. So the bonds are issued at a discount. So yield is greater than coupon. That is what the investors can earn is greater than what the company is actually going to pay out. Interest is paid every April 1 and October 1. So every 6 months they are paying the interest. So it's a semi-annual payment. What amount should Mason report for interest payable in its 31st December balance sheet? So what is important to understand this? See, listen, first, they're asking us to calculate interest payable. How do we calculate interest payable? It is coupon into face value. Coupon rate into face value. Coupon rate is given in the question, 8%. Face value is also given 8 lakhs. But the interest is not paid on an annual basis. Interest is paid every 6 months. That is April 1 and October 1. Now, on which date the bonds were issued? The bonds were issued on 1st of November. But the bonds are dated on October 1. So, what is important is, even though the bonds were issued on November 1, still we have to calculate interest from October 1 because the 8-term bonds dated from October 1. So interest should be calculated from the dated day. So October 1 onwards, we have to calculate the interest even though the bonds are issued on 1st November. So how many months interest is accrued? October, November, and December. So 3 months interest is accrued. So what is the amount of interest payable? Interest payable is nothing but face value into coupon rate. Face value is 8 lakh into coupon rate is 8% into how many months interest is accrued? 3 months, October, November and December. Again, I'm repeating the bonds were issued on November only, but still the bonds are dated on October 1. So we have to calculate interest from the dated day, that is October 1. So 3 months interest is accrued into 3 by 12. So it is 64,000 into 3 by 12. We get $16,000. Option B is the right answer. So $16,000 is the interest payable in its 31st December balance sheet. Question number 6. On January 1, year 4, Cell Corporation issued 9% bonds with a face value of 1 million, which mature on 1st January year 14. So what is the maturity period? 10 years. The bonds were issued on 4th of January, 4th year, and the bonds are going to be mature on 14th, year 14th. So it's a 10-year bond. The bonds were issued for 9,39,000 to yield 10%. Again, what is the coupon? 9%. What is yield? 10%. So if yield is greater than coupon, the bonds are issued at discount. So the investors can purchase the bond for 9,39,000 and after 10 years, they are going to get back 1 million. 1 million is nothing but 10 lakh. resulting in a bond discount of 61,000. So $61,000 is nothing but difference between 1 lakh and 9,39,000. CELT uses the effective interest method of amortizing bond discount. Interest is payable annually on 31st December. At 31st December year 4, that is at the end of the first year. I'm telling year, this is the first year because on January 1, year 4 only the bonds were issued. I hope you're all understanding it. So at 31st December year 4, that is at the end of the first year from the date of issue of the bonds. CELT's unamortized bond discount should be how much? So when they are asking us to calculate unamortized bond discount, it is very simple. Listen, the total discount is $61,000. Correct. At the end of the first year, we would have amortized some discount. What is that X amount we have to calculate? Right. How do we calculate unamortized discount? Sorry, how do we calculate amortized discount? The total discount is 61,000. From this, if we subtract the amortized discount at the end of the first year, we will get the unamortized discount. Now, how to calculate this amortized discount? We already discussed. This amortized discount is nothing but the difference between interest expense and interest payable. So just calculate interest expense and calculate interest payable. Calculate the difference between them. We will get amortized discount. So from amortized discount, from total discount, if we subtract amortized, we will get the unamortized portion. So first, let's calculate interest expense. What is interest expense? Yield into opening balance. So at the beginning of the first year, what is the opening balance? The issue price is the opening balance. The bonds were issued for 9,39,000. So 9,39,000 into 10%. We get $93,900 as the interest expense. What is interest payable? It is face value into coupon rate. What is the face value? Face value is 1 million or 10 lakh. Into what is the coupon rate? 9%. So we get 90,000. So what is amortized discount? The difference between interest expense and interest payable. So 93,900 minus 90,000, we get 3,900 as the amortized discount. Now what will be the unamortized portion? It is 61,000 minus 3,900, we get $57,100. So option D is the right answer. Question number 7. Which of the following statements describes the relationship of interest expense related to bonds payable when a discount on bonds payable has been recorded using effective interest method? So they're asking us which of the following describes the relationship between interest expense related to bonds payable when bonds are issued at discount. So we have to look at each of the options and we have to say which relationship is true. Interest expense will remain the same each year. You can look at this example. The interest expense is changing. Why interest expense is changing? Because opening balance at the beginning of each year is changing. See, so interest expense is not remaining constant. In fact, if the bonds are issued at discount, if you want, I can write it over here again. If bonds are issued at discount, interest expense will increase every year. Why interest expense is increasing every year? Because reason, the opening balance, which is used as the basis for calculating interest expense, is increasing. Reason, opening balance is increasing. But what if the bonds are issued at premium? If the bonds are issued at premium, then interest expense will decrease every year. So why interest expense will decrease? Reason, just opposite. If bonds are issued at premium, then opening balance is decreasing. Right. So option A is not the right answer because interest expense doesn't remain constant every year. Option B says interest expense will decrease each year. No, if bonds are issued at discount, interest expense is increasing every year. It is not decreasing every year. So This is not the right answer. When interest expense will decrease each year? Interest expense will decrease each year if bonds are issued at premium. Interest expense will increase by the same amount each year. Again, here you can see what is the difference between the interest expense. What is the difference between the interest expense in the first year and second year? It is 9683 minus 9621. Here it increased by $62. Here what is the change? 9751 minus 9683. We get extra $6. It is increasing every year at an increasing rate. It is not increasing at the same rate. So options, it is not increasing by the same amount each year. Option C is also not the right answer. Option D says interest expense will increase by a larger amount each year. Option D is correct because first year, I mean between year 1 and 2, you can see there's a $62 increase in interest expense. But from year 2 to 3, there is a $68 increase in interest expense. So every year interest will increase, interest expense will increase by a larger amount if bonds are issued at a discount. So option D is the right answer.